Hi, Assalamualaikum warahmatullahi wabarakatuh. My name is Nurul Sajidah binti Norisham. My matric number is D201810820009. 7-Eleven Malaysia Holdings Berhad through its subsidiary 7-Eleven Malaysia Sendirian Berhad is the owner and operator of 7-Eleven in Malaysia. Incorporated on 4 June 1984, 7-Eleven Malaysia has made its mark in the retailing scene and has been a prominent icon for over 28 years. 7-Eleven Malaysia is the single largest convenience store chain with more than 2,400 stores nationwide, serving over 900,000 customers daily. 7-Eleven was founded by J.C. Thomson in 1927 as the Southland Ice Company in Dallas, Texas. Started as an ice vendor, the company eventually began offering milk, bread, and eggs on Sundays and evenings when grocery stores were closed. This new business idea produced satisfied customers and increased sales, spawning the precursor of the modern convenience retail concept. So, 7-Eleven have their own tagline, which is 7-Eleven always there for you.
7-Eleven Malaysia is the largest 24-hour convenience store operated in Malaysia till to date. Based on the capital structure, the net profit ratio in 2017 is 89.23, whereby it's the second highest of the ratio gained by 7-Eleven Malaysia Holdings Berhad. The total comprehensive income and revenue are essential financial indicators that illustrate how much money a company makes. The total comprehensive income that generated was calculated by deducting the operating expenses, tax expenses, other expenses from revenue. Revenue and operating income are important in determining whether a company is performing effectively or not. The operating profit margin indicates how well the company managed to pay the company's 7-Eleven Group's objectives when managing their capital to maintain a strong capital base and maintain investor creditor and market confidence, also to sustain future development of the business. The group maintains a balanced level of total equity to ensure the company has adequate capital which helps to support their future development. And nevertheless, the company maintains the payment of dividends to the owners of company. Return on equity ratio helps to compare the income with the equity which investors have invested. ROE in 7-Eleven Group maintains, which reflects the group increasing their ability to make a profit without needing as much money to do so. Earning per share (EPS) of the organization in 2020 is lower compared to the previous years. Furthermore, debt to equity ratio indicates how the group has been aggressive in financing its growth with debt. The 7-Eleven Group has decreasing to the constant rate in debt to equity ratio from the year 2017 to 2020. The group has debt to ratio equity of 0.06 and 0.03 in the respective years for 2018, 2017, 2019, 2020, which reflects that the group can easily service its debt to obligation through cash flows and help to leverage their equity returns to increase.
Debt to equity ratio. DE ratio is used to evaluate a company's financial leverage. This ratio measures the degree to which a company is financing its operation through debts versus wholly owned funds. The chart shows the DE ratio in 2017 is 0.06 and maintained 0.06 in 2018. Yet in 2019, the DE ratio fell to 0.03 and rise to 0.33 in 2020. The higher debt ratio indicates higher risk of closure or bankruptcy. Besides, the lower DE ratios indicate lower risk. The lower the risk, which is below 1.0, the more likely 7-Eleven is receive the loan and have an investor comes on board. Generally, the lender always see companies' DE ratio below 1.0 as good and ratio above 2.0 as bad. The debt to equity ratio meaning is the relationship between 7-Eleven's debt and equity to calculate the financial risk of their business. If 7-Eleven have more debt than equity, they may not qualify for loans. Instead, have more equity than debt, their business may be more appealing to investors and lenders. Equity multiplier ratio. The equity multiplier ratio is a financial leverage ratio that measures the portion of a company's assets that is financed by the stockholder equity rather than by debt. The chart above shown, the equity multiplier ratio in 2017 is 1.06 and maintained 1.06 in 2018. Yet in 2019, the equity multiplier ratio falls to 1.03 and rise to 1.33 in 2020. It's shown that 7-Eleven Malaysia Holdings Berhad have low multiplier. A lower multiplier is considered more favorable because such 7-Eleven are less dependent on debt financing and do not need to use additional cash flow to service debt like highly leveraged firms do. In other words, a company with a lower ratio are less dependent on debt financing and do not have high debt servicing costs.
I am Nur Imani binti Hassan and my matric number is D082031. So I will continue presenting about data analysis for 7-Eleven Malaysia Holding Berhad, which is earning per share. Okay, earning per share is calculated as a company's profit divided by the outstanding share of its common stock. Here you can see earning per share ratio chart from 2017 until 2020 for the 7-Eleven Malaysia Holding Berhad. As you can see, qualities EPS for the respective years 2017 until 2020 are 4.67, 4.96, 0.45 and 4.76. This means that if quality distributed every cent of income to its shareholders, each share would receive 4.67 cents, 4.96 cents, 0.45 cents and 4.76 cents for its respective years. So higher EPS is always better than a lower ratio. So the highest EPS ratio is in 2018, which is 4.96. That means in 2018, the 7-Eleven Malaysia Holding Berhad has more profits to distribute to its shareholders compared the other years.
The debt to capitalization ratio is a tool that measures the total amount of outstanding company debt as a percentage of the firm's total capitalization. The chart above shown the debt to capitalization ratio in 2017 is 6% and maintained 6% in 2018, yet in 2019 this ratio falls to 3% and rise back to 25% in 2020. If a company has a high debt ratio above 50%, it is often considered to be highly leveraged, which means the most of assets are financed through debts, not equity. The debt to capital ratio gives analysts and investors a better idea of debt 7-Eleven Malaysia Holdings Berhad financial structure and whether or not the company is suitable investment. Various industry and excellent debt to capital ratio is under 0.7 or 70%.
I am Nur Imani binti Hassan and my matric number is D082031. So I will continue presenting about data analysis for 7-Eleven Malaysia Holding Berhad, which is earning per share. Okay, earning per share is calculated as a company's profit divided by the outstanding share of its common stock. Here you can see earning per share ratio chart from 2017 until 2020 for the 7-Eleven Malaysia Holding Berhad. As you can see, Quality's EPS for the respective years 2017 until 2020 are 4.67, 4.96, 0.45 and 4.76. This means that if Quality distributed every cent of income to its shareholders, each share would receive 4.67 cents, 4.96 cents, 0.45 cents and 4.76 cents for its respective years. So higher EPS is always better than a lower ratio. So the highest EPS ratio is in 2018, which is 4.96. That means in 2018, the 7-Eleven Malaysia Holding Berhad has more profits to distribute to its shareholders compared the other years.
Hi, let's move on to the ROE ratio, return on equity. ROE basically is to measure how much a profit made by a company based on the money that invested by the shareholders. To get ROE, we have to evaluate by dividing net income with the shareholders' equity. From the line chart shown, we can see that the highest ratio of ROE is in 2018, that 4.03%. It is because 7-Eleven company utilized the assets in effective way to produce sales revenue. In 2017, the ROE ratio is the second lowest among 4 years at 3.82%. And then the ratio slightly increased to 4.03% in 2018. As I explained earlier, it is the highest ratio of ROE. The following year, 2019, it shows that the ROE ratio dropped drastically to 0.38%, the lowest it has ever been. This case usually due to the management of the company is not creating enough revenue or investing properly. However, the ROE ratio climbed back at 4.01% in the year of 2020. So we move on to the net profit ratio. It shows how much net income gained by a company with the total sales. To get net profit ratio, net income divided by net sales. In the chart, we can demonstrate that the net profit ratio in 2017 is 89.23%, which is the second highest gain by 7-Eleven company. It shows that the company controls its costs effectively and manages goods and services with a low than its cost. The ratio slightly increased to 91.03% in 2018, and then in 2019 the ratio dropped down to 51.03%, which is the lowest because the company did not manage the cost of goods so accurately. However, net profit ratio increased to 67.62% in 2020. This is due to the company attempt to renew financing loan to lower the interest rate.